The price of uranium has quietly surged over 50% since Russia's invasion of Ukraine, reaching levels not seen since the 2011 Fukushima disaster. This isn't just about nuclear power. It's about how geopolitical tension creates a hidden premium in everything, from your grocery bill to your retirement account. When military tensions rise between nuclear-armed states, markets price in what analysts call the nuclear risk premium. We saw this during the Cuban Missile Crisis, the North Korean nuclear tests, and now with escalating tensions in Ukraine and Taiwan. This premium doesn't just affect defense stocks. It ripples through the entire global economy. The mechanism is straightforward, but often overlooked. Military tensions drive up energy prices first. Oil and natural gas typically rise 15 to 25% in the months following major geopolitical escalations, according to historical data from the International Energy Agency. This happened after Russia's invasion, when European natural gas prices briefly soared over 300%. These energy spikes trigger a cascade through the supply chain. When diesel costs rise, shipping becomes more expensive. When shipping costs more, food prices climb. When food prices increase, wages face pressure to follow. It's a domino effect that eventually reaches your local supermarket and your investment portfolio. Historical patterns show that nuclear tensions create particularly stubborn inflation. During the 1962 Cuban Missile Crisis, consumer prices rose approximately 6% in the following year, nearly double the previous rate. Why? Because nuclear risk makes businesses more cautious about long-term investments and encourages them to build costly redundancies into their supply chains. For your personal finances, this means 3 things. First, your emergency fund needs to be larger than you might think. The standard advice of 3 to 6 months of expenses may need to be 6 to 9 months during periods of elevated geopolitical risk. Second, your investment portfolio needs to account for these hidden premiums, particularly in sectors like energy, agriculture, and defense. Third, and perhaps most importantly, you need to understand how these risks affect different asset classes. Gold and other precious metals typically rise 8 to 12% during periods of nuclear tension, according to analysis of the past 5 major crises. Government bonds from stable, nuclear-armed nations tend to attract safe haven flows. Meanwhile, emerging market currencies often face pressure as capital seeks safer shores. The practical takeaway isn't to panic, it's to prepare. Consider allocating a portion of your portfolio to inflation-protected securities. Look at your exposure to regions and sectors that historically benefit from security concerns. Review your insurance coverage. Many policies have exclusions for acts of war that you should understand. Remember that markets have survived and eventually thrived through every previous period of nuclear tension. The goal isn't to predict the unpredictable, but to build resilience into your financial planning. The data and trends discussed here are drawn from publicly available sources and historical patterns, but they're meant for education, not prediction. Always consult a qualified financial professional for advice tailored to your specific situation. That wraps up Moneywise Daily. The world moves fast, and so does your money. Follow the channel to stay ahead. We'll see you next time.